This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
I'm Zack Fuss, and today we are breaking down Siemens Energy, a spinoff from industrial giant Siemens completed in 2020. Siemens Energy operates across the entire energy value chain, with a significant presence in both conventional and renewable power. They are a major player in gas turbines and power generation, while also more recently taking full control of Siemens Gamesa renewable energy. What makes this company particularly interesting is its position at the forefront of the energy transition. As the world moves towards more sustainable energy systems, Siemens is uniquely placed to bridge the gap between traditional energy sources and renewables. However, the company faces real challenges, particularly in its renewables division. Siemens Gamesa has been dealing with a litany of issues, including supply chain disruptions, project delays, and technical issues with their turbines. It presents a complex situation for Siemens Energy as they navigate the shift to green energy. The company's ability to leverage its expertise in conventional power to address these renewable energy challenges will prove to be crucial. As the global economy balances the demands of incremental energy along with a mandate of decarbonization, Siemens Energy will play a vital role. To break down Siemens Energy, I am joined by Mark Hiley, the founder and managing partner of The Analyst, a London-based independent equity research firm. We hope you enjoy this breakdown of Siemens Energy. Mark, thanks for joining us to break down Siemens Energy. It's a business that, as early as 2019, Siemens, the larger conglomerate, started to discuss its intention to kind of separate. And now with it being an independent public company, I thought maybe we just kick things off with talking about the impetus for the demerger and kind of what the business represents to you today.
It's an interesting business. Siemens, as most people will know, is a very old company. It's over 150 years old, founded in the mid-19th century by Werner von Siemens. It's been a sprawling engineering business. They were pioneers in many of the electrical innovations in the 19th century. And then it became a much bigger industrial conglomerate through most of the 20th century. In 2019, 2020, they started to discuss the spin-off of Siemens Energy, which is the business in gas and power and wind, which we'll be discussing today. But prior to that, they'd already spun off Siemens Healthineers, which was their healthcare business. Healthineers then went and acquired Varian, the large radiotherapy business. And Siemens AG retained their core industrial businesses, which were Digital Industries is the main division inside Siemens AG today. And that has a lot of software and industrial applications. So the idea with Siemens Energy was that in 2020, the business needed separate focus, given the megatrends which were on the horizon around renewables, grid, this sort of revolution which was coming on the world around energy networks. And also within Siemens Energy, there'd been some problematic businesses. So the gas and power business, although it's profitable today, had actually had some challenges inside Siemens. It had been loss-making. They'd struggled with some of the platforms. They had probably had too many products and a lack of focus. So Siemens AG really, from the top down, was trying to improve capital allocation, start to focus really on shareholder value, which was a big change for Siemens AG, given that it was a 150-year-old German conglomerate, and reduce complexity. So that's how Siemens Energy came about, and it was spun off from Siemens in 2020. Siemens AG retained something around a 30 to 40% controlling minority shareholding. They've subsequently sold down some of their stock and put some of the shares into the Siemens AG pension fund, and the pension fund has sold. And you now have Siemens Energy listed today, about 20 billion euro market cap in Germany. And the most comparable business, probably GE Vernova. So also interesting to note that Siemens AG was slightly ahead of GE in doing this breakup. And really what the breakup's all about is simplifying and giving more transparency and more accountability inside a big conglomerate. And of course, that's the path which GE followed more recently.
So now we have this somewhat more simplified, but still a beast of a business, as I think you would agree. If we were to kind of break it down a step further into the segments and how you think about them, what are the important business units to address here?
So somewhat more simplified than the old Siemens AG conglomerate, but still quite a complex business to get into. And this is what has fascinated me as an analyst looking at it over the last few years. We have quite a history researching the company, which we can talk about later in the episode. But basically, Siemens Energy, you have around 40 billion euros of revenue today for the whole company. But behind that, there's an order backlog over 110 billion euros. There's two businesses. The first business is gas and power, and that's a business with around 25 billion euros of revenue. Then there's just over 10 billion euros of revenue in wind. We can break that down even further. Within gas and power, there's three divisions. The biggest, probably the most important, is the gas service business, which is actually quite a simple business in a consolidated market. That's about 11 billion of revenue, double-digit margins. Grid technologies is another 10 billion of revenue. So these are bits and pieces to build power grids, HVDC converters, large pieces of substation kit, anything you need to make transmission work. That's also a double-digit margin. Then you've got something they call transformation of industry, which actually has four subdivisions in it. Sustainable energy systems, which is very small. That's essentially a hydrogen business. Then what they call electrification, automation, digitalization, which is a catch-all for bits and pieces for controlling power systems. Industrial steam turbines and generators, quite self-explanatory, and compression kit. And what brings all of that gas and power business together is that they are essentially selling into traditional grids. So the big customers here are national or state electricity companies, someone like National Grid in the UK or Tenet in Europe would be a big customer. It's very profitable, growing, although it wasn't profitable and growing 3 or 4 years ago. And then you've got the wind business. That's about 10 billion euros of revenue. And it's called Siemens Gamesa Renewable Energy. That was formed through the merger of Siemens Wind and Gamesa Renewable Energy, Gamesa being a Spanish business that was previously listed on the Spanish stock market as SGRE, Siemens Gamesa. Siemens Energy, or Siemens before them, always had a majority stake in that business. And then a couple of years ago, they took out the minorities. They now own 100% of Siemens Gamesa Renewable Energy. So that's a 10 billion euro wind business competing with Vestas and GE. It's massively loss-making. It's been an absolute disaster, which I'm sure we're going to get into. It's probably going to lose close to 2 billion euros this year and maybe more on a cash basis. So you wrap it all up together, you have a 35 billion euro business by sales, which is not profitable yet at the group level because of those big losses in wind.
I'm going to want to go into each of the kind of subsegments in greater detail, but I thought it may be helpful to kind of take a step back in that you kind of referenced that there are a number of divisions that are now profitable that hadn't been. And my guess is that just given the convergence of a number of themes, primarily around electrification and the green transition, that the business is now strengthening into that transition. What exactly has occurred which has led to increased demand and revenue drivers for the business broadly before we just jump a little bit deeper into the segments?
So gas and power, as I said, was actually loss-making in 2019 and 2020. And back then, Siemens was struggling with cost base, the manufacturing footprint, the complexity of the business. And of course, the demand was also in a much lower place. It was a completely different demand picture from what you see today in 2023 and 2024 when grid investments are booming. So back then, the core gas service business, which sells large generators for gas power generation, that was a shrinking business. with large losses on the new units. The grid technologies back in 2021 was only taking less than 10 billion euros of orders a year. It wasn't really growing and it had low single-digit margins. Now, roll forward 3 or 4 years and demand is booming. So what's happened really is that as you add more renewable energy to the grid, as you put solar and wind on the grid, that creates more variable load. And that creates a need for resiliency. So you have to reinvest in gas capacity to balance for when the wind's not blowing or the sun's not shining. On top of that, countries are becoming more interconnected. So if you think about Germany, they may have solar generation in the south, they may have wind generation in the north. And it may be that at night, the wind is blowing, but the sun isn't shining. So you need to find ways to move that energy from the north to the south. And that requires a lot of resiliency and interconnection, and new cabling, a new substation around the German grid. But not only that, the European countries, including the UK, even after Brexit, are starting to integrate their power networks. So there'll be cables run from Scotland to Norway, Denmark to the UK, and each country individually is realizing that they need to interconnect to manage the more variable generation and, of course, move away from reliance on Russian gas. The Ukraine war really highlighted a need for energy independence. So there's plenty of strong drivers. Overlay that with legislative changes, targets towards net zero, and then also big changes on the demand side. So as you connect data centers or electric vehicles to the grid, as there's more electrification of industry, that creates a much bigger pull on the demand side, and that stimulates increased demand for low voltage and medium voltage components on the demand side. And of course, the more you load in there, the more resiliency you need in the high voltage and the core grid. So basically what you've seen is the CapEx budgets and the multi-year strategic plans at the national grid operators have increased materially. So companies like E.ON and National Grid have doubled, tripled, quadrupled their CapEx plans. You're seeing the same in the US, and I think the state of Texas is talking about interconnecting with the rest of the US. Some states are starting to talk about moving to high voltage power, direct current instead of AC current. So there's these big megatrends happening, and that's really put a fire under the demand side. So grid gas and power at Siemens Energy, the order books exploded. It's more than doubled over the last 4 years. It's still growing strongly this year. You see that on the grid technology side, also on the gas service side, which we'll probably get into next. There's an expectation that there'll be an increasing demand for gas power generation units. 5 years ago, the consensus would have been that that's a terminal or a structurally declining market. So these businesses are actually capacity constrained. Siemens Energy and GE Vernova, if you go to them now as a large grid operator, you're going to struggle to get delivery slots in the next few years. So the order books are lengthening. I think these companies have pricing power, which they didn't have before. And on top of the pricing power, they're able to cherry pick the best contracts and then place those contracts into their order backlog in a more efficient way. They've simplified their product portfolios. If you look elsewhere in the sector, there's other listed stocks in Europe, companies like Prysmian, NKT, and Nexans, which simply do the high voltage DC cables. And those companies are now taking orders which will be called off into the 2030s. So it's almost like all these companies that supply power grids are becoming sold out, at least until the end of the decade. So a big shift in the demand supply picture driven by these megatrends.
So in the context of a strengthening backdrop, I love to spend time on the business units themselves and just better understand what the competitive landscape looks like, the basic revenue model. Perhaps it makes sense to start with gas services, given that it's the largest and most profitable unit. We'll love to hear more about how the business functions and what its strengths are.
So gas service, which is power generation, so gas and steam turbines, also some engines, controls, and electrical systems. But think about Siemens Gas Service as selling the large gas turbines which generate power from gas. It's a very consolidated market. You've got Siemens Energy, Mitsubishi, GE Vernova, and Baker Hughes playing that. And then there's a smaller company, Ansaldo Energia, which was taken out. I believe that's an Italian company. But it's a very consolidated market. And you basically have somewhere between 100 and 110 large gas turbines built every single year. And that's been broadly in line with the demand in the market. Demand more recently is expected to go up. So there's a belief that data centers could add demand for at least another 30 or 40 large gas power plants a year. So this is about the growth in electricity demand. So it's a consolidated market. Siemens Energy, one of the largest, they're good at it. And as I said, over the last few years, they've consolidated their product line into a sort of more modular offering. So that's about an 11 billion euro revenue business, double-digit margins. But I think the interesting thing about this business is it's all about service contracts. So if you look at the revenue breakdown, although maybe 35-40% of revenue is from new units, the profitability is really coming from the service contracts. So there's a very high attach rate for the customers. Siemens Energy, very sticky on the service contract. Obviously, it makes sense for a Siemens engineer to service a Siemens turbine. And the turbines and the gas service businesses have very, very long duration. So they'll be in place for decades. So you have very long-term sticky service contracts. And we think that service margins are probably now above 20%. So if you can break even on new units and build up the installed base and then attach those service contracts at 20% plus margins, you have a very attractive business. And I think the other thing maybe just worth highlighting here is that it's a very capital light business. So although Siemens Energy don't disclose anymore the CapEx by subdivision, we do know that the CapEx for the whole gas and power business is only around 500 or 600 million euros a year. And that's a business which is 25 billion euros of revenue. So the economic profile of gas service should be extremely attractive. Double-digit margins, CapEx to sales ratio below 2%, and a very simple long-duration service business, essentially.
To the extent that they can reinvigorate growth in that particular segment, where would that growth come from?
Again, going back to where we got into 10 minutes ago on this episode, 4 or 5 years ago, the common view was that the number of gas power generation units in the world, particularly in Europe and the US, would decline. And then what's happened is that governments and grid operators have realized that as you add wind and solar to the grid and you increase the renewable mix, you actually need more resiliency in the grid. So you need base load. And if the most simple way to think about it would be in the case of a peaker. So a gas peaker is quite a simple gas turbine which you can turn on and off depending on the needs of the grid. So, in the UK, we've added plenty of wind. Now, when the wind isn't blowing and Coronation Street is on, which is a big soap opera on ITV, famously in the UK, in the advertising break of Coronation Street, everyone goes and makes a cup of tea. That creates a huge load on the grid. Everyone puts the kettle on. And of course, if you don't have wind at that point, you'll be short of electricity. So you need a steam peaker or a gas peaker, which you can turn on in anticipation of the load. So that gas business is moving back to growth as the energy mix changes. And then also governments are trying to phase out coal. So particularly in Germany, the phase out of coal to meet their larger objectives around net zero and all the German government's commitments. The phase out of coal is requiring more gas capacity and more baseload. So that's a market which is probably going to start growing the installed base. And then you add data centers in, which create a huge step change in energy demand. If you assume North American and European energy demand starts growing at 2-3% a year, you're going to need more power generation capacity. And you can meet it by adding solar and wind. But if you add more solar and wind, as I said, you need backup. And no one wants to be on coal anymore. So you need gas, and Siemens Energy are the market leader there.
The growth engine of the business today is seemingly grid technologies, which is outpacing the rest of the group meaningfully. What is that business value prop, and who is it competing with, and what are the core services it's providing?
So we keep dropping down through the gas and power business. So that was gas service, which was expected to be no growth, but now is expected to be growth. And then we get into the exciting bit of Siemens Energy today, which is grid tech. To my mind, this is their best business today from a growth and economic profile perspective. It's about 10 billion euros of revenue, but in the last 2 years, the order intake has at least doubled. It's gone from taking less than 10 billion euros a year of orders to around 20 billion euros a year. And the backlog has more than tripled. The backlog in 2021 was 10 billion, and it's now well over 30 billion euros. And the company's guiding for Grid Technologies to grow revenue above 30% this year. And they had a capital markets day in Germany at the end of last year, and they described it as low double-digit growth, which I suppose could be anything between 10 and 45%. So they've been kind of unclear on what the growth rate is, but last year they grew 17% comparable. This year, as I said, they're guiding for over 30. The order intake has doubled, the backlog has tripled, and their core customers have doubled or tripled their CapEx budgets. So this will be a very, very strong growth business. It could grow around 20% top line to the end of the decade. So much faster growth than gas service. And this is where they're selling essentially large bits of kit to make a power grid work, to make sure energy and electricity is transmitted. So high voltage components, interconnectors, AC components. If you think about driving around and you see the overhead power lines, often next to those power lines, you'll see a substation. And that substation, which from the outside looks like a bunch of grey boxes, will be full of Siemens Energy component. If you build an offshore wind farm, you probably need an offshore substation. That would also be full of Siemens Energy kit. Quite a simple business, also likely to be a double-digit margin. The company's guiding 8 to 10%. Also a very capital light business in terms of having a very low capex to sales ratio, so a very high return on capital, and a very high growth business. There's obviously a question here about how much they can grow. I think in the next few years, they'll probably be approaching practical capacity. So their customers will now be screaming at them for more capacity and screaming at them to add factory footprint to meet demand. So I think in this business, the Siemens Energy management will have an interesting question around capital allocation. There'll be a big decision here about factory footprint towards the end of a decade, but essentially a very high growth, very attractive business.
And in the context of this Grid Technologies business, clearly there is a supply-demand imbalance globally right now, perhaps a pull forward in demand. If you think about through a cycle how this looks, or even today from a competitive perspective, how do they pick and choose who to award business to versus not? And then I guess conversely, how do customers decide who to contract with and who they want to work with? What is the landscape?
Very consolidated market, very few players in here. GE, Vernova are more on the gas service side. So in this business, you've got Siemens Energy going up against companies like Hitachi, Mitsubishi, very large player. And customers here are looking for long-term partners. The technology in this area is very mature, but the orders are large. And they need a partner who can provide components and be there for them over the next 20 or 30 years. So these are governments and grid operators making very large orders, which will be pulled off towards the end of the decade. So they need large, reliable partners. Siemens Energy, it's a business employing, I think, around 90,000 people. It's a business with a 150-year history. It's a business with a very good reputation for engineering, maybe less of a good reputation for long-term shareholder value creation, if you look back historically. But as with many German engineering companies, you sort of have the best of German engineering excellence in here. So Siemens Energy are often the only game in town, particularly in Europe. They're extremely dominant. The industry's now capacity constrained, and you need someone who's going to be in business in 10 or 20 years' time if bits of kit breaks down, if the warranty is needed, spare parts, upgrades, additional components. And really, Siemens Energy and other suppliers in this industry are working within very, very long-term strategic plans of the grid operators. It's quite a long cycle business. It's been a little bit boom bust historically. Obviously now people are starting to think, is this a super cycle? Right? We've got the reindustrialization of grid networks. Very, very exciting. But because of that capital light nature and the stop-start investment cycles of the customers, and also the sort of lack of energy demand growth over the last few decades. It's a business which has been boom bust. So I suppose investors are hoping that Siemens Energy shows some discipline, that they cherry pick the orders, that their customers haven't pulled forward all the demand on the back of Ukraine war and a sort of panic around energy security and high energy prices. But I think, a bit of context for that, although there certainly has been some pull forward of demand and the Ukraine war really brought the problems of grid resiliency into stark relief, the reality is these grids haven't had investment for decades. There's parts of the British electricity grid which have not been looked at since the 1980s. So there may be pockets of demand as products which have really been overlooked for maybe 30 or 40 years. So you could have really a long-lasting super cycle here. Of course, subject to energy prices, subject to political stability. There's legislation needs to be passed. The governments need to maintain their commitments to take action on climate. You need data center and electric vehicle demand to keep growing. But the pieces are in place for a very long cycle here. And it's early. As I said, we're only 2 years into the upswing on this business.
Yeah, I know if you look at some of the industry data, at least provided in the US, energy consumption and transmission growth was like a 1-ish% to maybe 2% industry, which is seemingly inflecting. I think you have a lot of that globally. So it seems like everything is coming together for this business to have a very long cycle here.
It looks like it. And as I said, these strategic plans of grid operators are running into the 2030s. And some of the Siemens Energy order book is for delivery in the 2030s. So this isn't really a short-term phenomenon. This is really what I think is a sort of generational change. You could even describe it as an industrial revolution, or at least a reindustrialization of energy grids. So although European economic growth at the high level is quite anemic, and people can look at Europe and say, well, it's sort of not that interesting from a macro point of view. And if you look at the US, we have companies like NVIDIA changing the world. There are pockets of very, very high growth in Europe, and there are global market leaders like Siemens Energy. So that's how I think about the market and the sort of discussions we're having with some of our clients.
And then the last unit before the wind business, which I think we'll spend a bunch of time on, just given the trials and tribulations, is this transformation of industry, which to me kind of serves as a catch-all, although it's not a tiny part of the business. It's, I believe, $4.5 billion of euro of revenue. Are there any little parts of that business or nuggets that you think are particularly worth discussing?
Yeah, it's about 5 billion euros of revenue. It's probably worth spending some time on hydrogen. I'm quite skeptical on hydrogen. There's been a lot of hype in the market. It's a lot of hope about hydrogen being a sort of new clean fuel. But if you look at the energy requirements to make and store hydrogen and then transport hydrogen, it's very difficult to understand a roadmap to scale that business up without large subsidies. I think ultimately hydrogen will be produced in the Middle East, where there's a lot of gas and sun, and you can perhaps store it in batteries, and there's a big need for local hydrogen. Siemens Energy is a hydrogen business in Europe, I'm not sure about, and there's been other hydrogen stocks listed in Europe. So there was one called Nel in Norway, one called ITM Power in the UK, and they've fallen on hard times in the last few years as the hype around hydrogen's worn off. That's what Siemens Energy called sustainable energy systems. But to credit the management, they're taking a very cautious approach. They have a JV in France with Air Liquide, a large industrial gas player, but a very cautious approach. It's tiny, not particularly relevant to the story. Then the other three pieces, electrification, automation, and digitalization. That's all one piece, but three words. Profitable, growing. And then the other two businesses probably are worth calling out quickly. Industrial steam turbines and generators, so these are smaller bits of kit, and compression equipment, both divisions which are not really structural growth, but businesses where Siemens Energy has a nicely profitable business, market leadership, very focused on a few products. So we probably don't need to spend too much time on that. I think about them more as a sort of cash cow, small cash cow businesses within the broader group.
And so I'm going to want to talk about the consolidated financial profile of the entire business, but it's impossible to do that without spending a fair amount of time appreciating what's going on with the wind business, with Gamesa. I thought maybe just to kind of start, you can take us through the business history and how it became part of the consolidated Siemens Energy business and what has transpired here over the long period of time, but really in the past 5 years being most topical, because I think it is so important to the long-term story of Siemens Energy and trying to get this business back to a free cash flow positive part of Siemens.
Yeah, absolutely. So wind has been wild. We'll talk about industry fundamentals a little bit. We'll talk about market structure, but maybe first on Siemens Gamesa. If you roll back 10 or 20 years, the wind industry, particularly the European wind industry, was quite fragmented. There was probably 5, 6, 7 players in Europe. And of course, wind has been boom bust. Initially, in the early 2000s, heavily subsidized, with Germany leading the way on subsidies and creating this onshore wind market. And more recently, the focus has moved to offshore. The turbines have got bigger, the blades have got bigger, and plenty of players have gone bust or been consolidated. So Siemens wind business was merged with Gamesa wind business, so putting together German and Spanish players. 10 years ago, there was other German companies like Enercon, Senvion. There's another company listed called Nordex. But essentially, most of those players have consolidated down. And because the capital requirements and the technology requirements for offshore are so high, offshore is a very consolidated market. So onshore, you can think about that as a 3 or 4 player market. Vestas, Siemens Energy, GE, and perhaps Nordex in Europe. Offshore, very consolidated. Siemens Energy and Vestas in Europe, and Vestas and GE in North America. Siemens and Gamesa merged. I think it was probably 7 or 8 years ago, maybe even more. And that was listed on the Madrid Stock Exchange for a while with Siemens AG as the largest shareholder. And then after the Siemens Energy spinoff, Siemens Energy decided to take 100% ownership of that business. And they launched a bid and bought out the minorities of Siemens Gamesa. That was delisted from the Madrid stock market. The minorities were consolidated and squeezed out. And that's now a 100% owned business inside Siemens Energy. And if you go back to that Siemens Gamesa business, perhaps for your listeners, as a research business, we've done a lot of work on shorts in the past. We do a lot of work on accounting and governance. And Siemens Gamesa, when it was separately listed, was a business which we had a short recommendation on, really around bad accounting, bad governance, bad capital allocation, optimistic revenue recognition, poor levels in service. And Siemens Energy, Siemens Gamesa was always a poor second to Vestas. Vestas in recent years has had a much better track record of profitability, better balance sheet, generally perceived to have better management, better cash flows. Siemens Energy have really struggled in this wind business. It's generally been a loss-making or free cash flow negative business. Anytime they reported profit, it was kind of on an adjusted EBIT level, so not real cash profits. And then in the last 2 years, wind has been a bloodbath for investors. It's difficult to know exactly how much the wind industry lost in the last 2 years. It's probably running into the tens of billions. Siemens Energy lost 4 billion last year. Vestas was loss-making. GE's wind business, which is now in Vernova, was loss-making. And on top of that, the project owners were loss-making. So there's a very large offshore energy project developer called Ørsted, listed in Denmark. They had huge problems and big losses in offshore wind, particularly offshore US. And then a lot of the oil majors like BP and Shell have also lost money developing wind projects. I think we think, and Siemens Energy management would certainly say that those losses and that kind of heart attack for the industry last year may set up the industry for better times. But wind has really been boom bust. And I think it's because it's an industry which grew up on subsidies. So these businesses didn't really have a culture of unsubsidized profitability. So a lack of discipline on project pricing, optimism in accounting for project delivery, optimism around regulatory approvals, optimism on construction delays. So wind, very volatile. Even Vestas, if you look at Vestas, which is probably the best in the sector, If you look at that business on a 25-year view, their average EBIT margins, adjusted EBIT margins, have been around 4%. And it generally has gone through cycles of 3 years of losses followed by 3 years of profit. That hopefully will all change. And we'll talk about Siemens Energy's immediate issues now, but that's the backdrop for wind.
If you kind of think about what happened, you had these long-term contracts that were struck at levels that in an inflationary world they weren't able to deliver on without it being a meaningful loss. What does the future of this industry look like if you think about a capital cycle? Have there been people that have exited? What's going on throughout the value chain? And then looking at the Siemens wind business today, what are the opportunities and, I guess, threats going forward?
It's a long-term contract business. An offshore wind project, from negotiating and taking the order and placing it into backlog, it may then be 2 years, maybe 3 years before you get on site. And then it may be another 2 or 3 year construction phase. So offshore, which is really what Siemens Wind is all about now, is very long cycle business. Onshore, a little bit faster, but still 6 to 12 months at least to get on site, and then 12 to 18 month construction cycle. And as you said, there's been a lot of delays in the supply chain, lots of supply chain inflation. There's been issues in Europe getting regulatory permission. I think I read the other day that there was 80 gigawatts of wind sitting, waiting for regulatory approval to move forward. And then obviously what that means for a business fundamentally is that planning is extremely difficult. And wind historically has not been a business where people have been able to hedge components. Very hard to forward hedge steel 4 or 5 years out. Transport costs, almost impossible to hedge. And then obviously unforeseen delays. So weather conditions in the construction phase, local opposition to the project, availability of towers and cranes to erect this kit, availability of boats to get out into the sea and start laying the foundations. It's an industry which has been beset by challenges. And if you look at the supply chain today, because everyone lost so much money, I believe that there's going to be a lot of supply constraints because people are just not willing to invest in capacity for the demand which is expected to come, particularly in European offshore, in the coming years. So many parts of the supply chain, not just the turbine manufacturing. If you look at offshore vessels, cable laying vessels, gearbox manufacturers for wind turbines, the bearings components which go into the spinning turbines, they're all fairly consolidated markets where the supply chain has lost money or had problems. So people are hesitant to invest in capacity. And I think what that means for the next capital cycle is that there should, in theory, be a lot more discipline in more consolidated markets. As I said, in offshore, it's only really Vestas. Actually, it's only Vestas and Siemens in Europe. GE have retrenched as a business. They're focused more on their home market in North America. So if there is a capital cycle or a demand cycle, it will come into a very supply constrained and consolidated market. And then it will be upon the wind players to maintain discipline, which is something we've never seen in the past. So the big question when the offshore orders start to come in Europe will be what price and what risk parameters are the management teams of Vestas and Siemens Energy following? How disciplined are they in taking orders? Are they saying no to risky orders? Are they narrowing the scope of contract? Are they passing risk back to the project owner and saying, well, if there's delays, you need to pay for it. If steel costs double by the time I get on site, you need to pay for it. And I think that's the mentality the industry has to have. And it's really not had that mentality historically. So I think there's an acid test coming. And the other thing which is probably interesting to talk about is the diameter wars. So for 20 or 30 years, all the turbine manufacturers, the blade manufacturers have been in an arms race of building bigger and bigger and bigger turbines. The sort of standard platforms nowadays are maybe 12 to 16 megawatt turbines, and the last generation will be 20 megawatt turbines. And these largest offshore blades, I believe, are about 115 meter radius. So if you think about the swept area of the current range of offshore turbines, it's absolutely massive. And as of today, the supply chain doesn't exist to build and deliver a bigger turbine. And the blades have to be built next to the sea. So you have to find a factory where you can take the blades straight onto a boat because you can't transport these blades across the land. So what this could mean is an end to the diameter wars. Now, what that will require is that Siemens Energy, Vestas and GE essentially cease R&D in future larger turbines, and that they spend the next decade just trying to monetize the sunk R&D and capex which they've spent. The wind is a capital and R&D intensive business, and the industry historically has just lost money and always tried to build bigger blades. But obviously, as you build the bigger blade, you cannibalize your previous range of products, and you can generate more energy for fewer turbines. And that's a classic engineering problem, which I know you touched on in the Rolls-Royce podcast, which I thought was a great precedent for this episode. Lots of similarities about best-in-class engineering companies over-engineering, building bigger and a bigger engine or a bigger and a bigger turbine, and then essentially destroying industry returns. Could Siemens Energy be a 5% margin business instead of a perennially loss-making margin business? Maybe. Vestas publicly targeting 10% plus margins. Siemens Energy are talking about high mid-single digit margins towards the end of the decade. And they should also have a profitable service business. GE Vernova are getting back to break even, but it's really year one in the reset after an awful capital cycle. So this is the area of greatest uncertainty for investors. It's the area of greatest risk. As I said, Siemens Energy lost 4 billion last year. They'll probably lose 2 billion this year. There's a lot of provisions to work through. There's an onerous backlog. They had operational product problems with their 3X, 4X platforms in the onshore business. So a lot to be done, but probably the source of greatest opportunity and greatest risk.
It's interesting, and it'll dovetail into our discussion around the broader economic profile of the business. But you have this wind business, which is one of the dominant players. I believe it's the number one in offshore, number 3 onshore. Yet it's a business that this year is guided to lose around 2 billion euro in the context of a total business, which I believe is going to make anywhere from break even to $1 billion of net income. And so I guess just to tie a bow on it, how do you think about the strategic importance, the value of this entity within the broader business? And then zooming out further, if we could just talk about the financial profile of this business on a consolidated basis, given all the segments seem to be having pockets of strength and opportunity. Obviously, the wind business being a bit of an albatross today, but perhaps in the future it's not. How do you think about all that?
Wind is probably the biggest swing factor for the group. I think there was a time last year when the market thought that the losses in wind could sink the whole of Siemens Energy. If you look at the share price charts last autumn, they had to go to the German government for backstops, guarantees on their order book. So the customers were hesitant to place orders with Siemens Energy because of balance sheet frailty. There was concerns that they'd lose their investment grade status. Of course, without an investment grade rating, you're going to struggle to take large orders from grid operators in the 2030s. And it's commonly accepted that the gas and power business is good, profitable, growing, and wind is a disaster. Just maybe sticking on the economic profile of wind for a while. It's about 10 billion euros today in the group of 35. Loss-making, it's mainly an offshore business. And then there's a service business, which is about 2.5 billion euros of revenue. We really don't know how profitable that is. But sitting behind that 10 billion euros, there is a 40 billion euro backlog. And then if you just think about some of the numbers coming in wind, there should be, let's say, 10 to 20 gigawatts of offshore auctions in Europe each year for the next 5 years. 1 megawatt of wind prices around 1.5 million euros. So 20 gigawatts of offshore auctions could be 30 billion euros of business. And if we say that the European market is a duopoly in offshore between Vestas and Siemens, the business could start taking 15 billion euros a year of orders. And as I said, it's a 10 billion euro revenue business today. They'll get down payments on those orders, perhaps something like a 10% prepayment. So the company could enter a virtuous circle where the order book explodes and they get down payments, which help the cash flow profile. But of course, there's no visibility. To get back to break even in wind, which they target by 2026, 27, they need to deliver the onerous backlog. So they have loss-making onshore projects in their backlog today, which they need to work through by 2025. They need the offshore business to grow in revenue terms. That probably needs to double to fill up the factory footprint and turn a profit on the equipment delivery. And they need to restore the profitability on the service business. So there's a lot to do. But if the management are disciplined on new orders, you can see how this business turns around over the next 2 or 3 years. And if you believe what they say about where profitability on wind could be towards the end of a decade, then you're talking about a 2 billion plus swing in profit. And then if you look at that at the group level, gas and power probably accounts for at least 2 billion of net income. But as you said, the business is break even or loss making today because of wind. So you could have a couple of billion coming from gas and power. You could have a profitable wind business. So that's about a 2 billion euro inflection. And as we said, the market cap is 20 billion for the whole group. So these are very, very big numbers. But the visibility on wind is very low. Now, of course, if you look out much, much longer term, the whole idea of Siemens Energy, and maybe bringing this back to the start of the conversation, was that wind and gas and power should sit together naturally from an industrial point of view, because the grid of the future would start generating energy with an offshore wind turbine provided by Siemens Energy, with a service contract from Siemens Energy. That power, or those electrons, would be going into an offshore substation provided by Siemens Energy, the gas and power side. Then they'd go onshore, interconnecting into a national electricity network with a bunch of kit provided by Siemens Energy, and then moving around the energy networks to the end user with a bunch of kit provided by Siemens Energy. So there was a very sound industrial logic for putting the business together, and wind turbines and gas power plants conceptually sit together in terms of the new energy outlook. But as we sit here today, Siemens Energy has really not delivered on that vision. And Siemens Energy, it's been the problem child for the Siemens group. Siemens AG has a much stronger track record of consistent profitability. Siemens Healthineers, also nicely profitable. It's quite a steady defensive business. Siemens Energy has been a wild ride for investors. It's probably doubled and halved at least 3 times since the IPO. It's down 40% late last year when people worried about the balance sheet, and it's almost quadrupled since then. So not for the faint-hearted, but there is an industrial logic for the business.
Yeah, and I think in the spirit of capital allocation and also the balance sheet, whenever there are government-supported financings, people get concerned. Yet, if you look at the balance sheet today, it doesn't look like they're wildly levered. How do analysts look at their balance sheet?
They have net cash. They made some big disposals last year, so they sort of bailed themselves out on the balance sheet. They sold their stake in Siemens India, and because it's such a big, complex conglomerate, there were other businesses which investors were overlooking which were sold, so something called Trench. So there's plenty of disposal proceeds, and they've got a net cash balance sheet. Now, that requires some consideration. There's a lot of prepayments in there. So a lot of the gross cash in the business is not really their cash. You have to drill down a bit deeper. This is really one for the accounting specialists. But basically, when you take a long-term order, the customer gives you a prepayment. That goes into gross cash, but you also put a contract liability on the other side of the balance sheet. And Siemens Energy has net negative contract liabilities of about 13 billion, and net negative working capital of about 3 billion. So I think, although it looks like net cash and it looks like the balance sheet's strong, it's not quite as strong as it should be. The company will need to build up the net cash position, probably to a point where the net cash is higher than the net negative working capital. And then as we get to 27, 28, I'm sure there'll be questions around dividends and buybacks and M&A and deal making, but I certainly think that's a few years away yet. As it stands today, the balance sheet looks sound. They have the investment grade rating. They have the German government backstopping the orders. And then the gas and power really is a very cash generative business, but still losing money in wind.
I would hate to conclude the conversation on such a topic of skepticism, given the strength and power of the business. So maybe just for your concluding thoughts, we generally have a question around lessons learned and conclusion. Would be great to get your view.
Yeah, so hopefully we've been able to take listeners through the strengths and the weaknesses of the business and provide a balanced view. I mean, at its core, it's a large business. It's an exceptional engineering business. As a standalone entity outside of Siemens, there is more clarity around capital allocation, management accountability. They've simplified the business and they're market leader. So they're a large market leader in growth markets, in consolidated industries where you can put very profitable service contracts onto large pieces of kit, which sit in place for decades. So it has the makings of something very interesting, a European industrial champion, a world market leader of scale with massive megatrends, growth megatrends behind it, very powerful industrial reasons for an enduring upcycle. It has its problems, but I think it's a sort of big business which can navigate the cycles. And as a separate company, that's why I think it's interesting. And it's a business I have history with as an analyst. We used to look at Siemens Gamesa quite critically from an accounting perspective, and that's why I wanted to talk about it today. I think it's a fascinating company for investors to spend time on and a very broad range of outcomes.
Well, Mark, this is a fascinating business. I think given the location of our audience, maybe one that's underappreciated in the marketplace today, although with a global audience, probably less so. Clearly, the electrification of the grid and the growth of gas as a transition energy should be tailwinds. If they put wind together, presumably the prospects here are quite good.
And that's the idea. Yeah. And it's a business which can be compared to GE Vernova. It's a globally relevant business and definitely sort of touching on those megatrends around industrialization of the grids and energy networks and a return to growth. All the hot stuff in the market today.
Great. Well, thanks for joining us.
Great. Thank you very much for your time.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JoinColossus.com.